The UK smaller cap strategy is a segregated discretionary service run by Bate and myself. We invest in UK listed companies with a market cap up to £1.6 billion. They're UK listed, but by no means UK centric earnings, although holdings that some investors may be familiar with are the likes of Jet2, Gym Group, Halfords, but we pride ourselves on discovering gems in the dirt.
The strategy is special because our genuine focus on UK smaller companies. So this is an inefficient part of the market where we believe we can add genuine value via active stock picking. We started investing in UK smaller companies in spring of 2010, and we had a fantastic first 11 years. The last 28 months, however, have been more difficult. As a result of this, smaller companies have suffered more because of the reduced liquidity. This means the share prices have been particularly punished on the way down. Valuations on UK smaller companies in particular are incredibly low, and as a result we've seen significant enhanced levels of M&A from sophisticated players who are prepared to take longer term views. I think the backdrop for UK equities should be even more supportive if we see a continuation of the recent trends we've seen in inflation in the UK.
We do think we have an edge in our asset class. And if you have no edge, then you only outperform through luck, no matter what that asset class is. Here in UK smaller cap, the edges may be defined by the fact my background's not private clients, it's actually institutional, which means we're very plugged in now to institutional access for IPOs, secondary placings, research and company access. So we'll only invest in stocks for clients having met the companies face to face. We have a preferred list of about 55 companies at any one moment in time, and we commit to building a 15 stock minimum portfolio for investors, depending on the size of the consideration. The entry point for the service is £30,000, there's no maximum. Biggest client's got about £4 million of the service. He or she will have more like the whole collection of 50 to 55 stocks to give everybody a suitable level of diversification. The strategy is deemed appropriate for those prepared to take a higher degree of risk. Core sectors that we like are healthcare and tech, with the secular growth drivers prevalent in those spaces. We also like retail, leisure and industrials. Risk mitigation, we try and avoid certain parts of the market where we deem risks to be too high. Those include banks and insurance companies where research tends to be quite tricky because of the opaque nature of the companies, and also sectors that are prone to governmental interference like utilities and telcos.